ARB Holdings has reported a 4% increase in interim headline earnings per share to 15 cents. And joining me now in studio is the company's CEO, Byron Nichles. Thanks so much, Byron, for joining us this afternoon. Well, ARB is a wholesaler of electrical equipment primarily, and it feeds into the infrastructure story. It's a story that hasn't been very positive, and yet you've been able to maintain a pretty steady track record here. As I said, HEPS up 4%, revenue up 13%, and operating profit rising 8% as well. One would assume that you're happy at least that it's been smooth sailing through torrid times.
Yeah, absolutely. I think the trading performance certainly we felt was very pleasing. As you mentioned, the market has been very tough. And I think part of the success of ARB in being able to navigate the stormy waters has been the fact that we've got a very diverse customer base. If you look at, we've got over 5,500 active customers across a variety of sectors: mining, large industry, construction, infrastructure, government. And it's really the diversity in that customer base that has allowed us to maintain a steady ship, as you termed it, in very tough market conditions.
It's not just diversification across sectors, though. I mean, let's take a look at some of the diversification on a geographic basis that you're boasting right now and how far that diversification actually extends.
Yeah, in terms of our markets, we are still primarily focused on the South African market. We have a branch network that extends across the entire South African landscape. We also do export product into our neighbouring countries and primarily into the SADC region. It is still small. We've adopted a cautious approach to sending product and supplying product onto the continent for all the good reasons that we understand that Africa is a difficult continent to deal in. But we're seeing good growth in our export revenue. So there's a little bit of geographic diversification that has contributed.
But
to
as
the
you've
results.
highlighted, primary exposure to the South African market. Is there something that could knock you guys off course moving forward? I mean, where do you see those potential hurdles?
Yeah, I think, certainly we've shown, and the business has got a 32-year track record, so over 32 years of riding the various business and economic cycles as they've been. The group has shown its robust model and its propensity to grow through that cycle. That said, no business is without risk. Certainly, the doldrums that the construction market finds itself in is a concern to us. It is a market that we do supply into. I think government spending is another massive area of interest for us because we supply a lot of product into that market. And then obviously the state of the economy as a whole. From a micro perspective, there isn't too much that really keeps us awake at night other than the normal sort of competitive.
When it comes to that economic scenario that you're operating within, though, I mean, it's very interesting that you're able to maintain your gross margins at 18.8%. Just how are you pushing that through, and how much of a challenge to get that right?
Yeah, absolutely. There's no doubt that the levels of activity and infrastructure spend have come off quite significantly over the past couple of years. What that means is that the competitive activity increases and the pressure is felt in the margin. I spoke earlier about the fact that we thought that the trading results were particularly pleasing to achieve double-digit revenue growth in this market, to maintain the gross margin. And in fact, at an operating level, our operating profit, in fact, was slightly higher than the revenue growth. So that's really been, I guess, the success story of the last 6 months. And our guys that are on the ground tell us all the time that it gets tougher, not easier. So we're pleased with that.
Well, feeding into the success of that story that you've been managing to tell, you've now bedded down the acquisition of Eurolux, and that came in at a price tag of 81 million rand. You've bought 60%. It used to be a supplier, so one can only assume that this now makes things more profitable for you, that you're going to be able to capture slightly more margin moving forward. Yeah,
I think the acquisition of Eurolux, in fact, it became effective on the 3rd of January. So none of its results are in the results that we've just reported. The more we engage with the company and the closer we get to the company, the more we're excited by the prospects. Sure, because our supplier, by essentially buying from a group company, we keep that margin that traditionally suppliers would make. It now forms part of our group, so that certainly aids. But the real excitement in Eurolux lies in the fact that we have very complementary product sets and very complementary rather than overlapping customer bases. What that means is ARB is traditionally very strong in the industrial and commercial sectors. Eurolux very strong in the domestic and retail markets. And it's really the opportunities that those complementary customer bases open and offer to our respective businesses, that gives us cause for excitement.
So diversification yet again. Added impetus, of course, is that rand strength that we've been seeing, because Eurolux imports all of its products. While you've got that, I mean, most of the products that they do bring in are imported from the East anyway. So, the rand strength is a factor that will come to bear on all the players that operate within that arena. How are you assessing that competitive landscape?
Yeah, all markets are competitive. As you mentioned, I think specifically on the Eurolux side, all its competitors are largely importers of product, primarily importers of product. So I guess the playing fields are level. The volatility in the rand does cause some challenge. But certainly, again, Eurolux is a business with a 22-year track record, certainly shown phenomenal growth over that period. And that's just one of the normal business challenges that we face every day, that it's not going to go away, so we have to deal with it.
If we look at a trait of your balance sheet, it's been described as extremely conservative, and I mean that further illustrated today. I mean, you've got cash of 240 million rand, no borrowings whatsoever. Is this a strategy that you're continuing with in the future?
I think one of the hallmarks or successes of ARB over the many years has been its cash generation. We have got a fairly cautious approach to taking on debt. It's not a specific strategy, but for so long as we continue to generate cash and don't need to engage in interest-bearing borrowings, it certainly keeps our balance sheet very strong. I often joke and say, the cash on the balance sheet without debt is what allows me to sleep at night, but it certainly keeps me awake during the day, because ultimately we need to find productive investment opportunities.
Where are those avenues? If you're searching for productive avenues, does it spell a future of more corporate activity?
Yes, certainly. I think we've been on public record as saying we are acquisitive. Again, if you look at the 4 years that ARB has been listed, one of the characteristics, and I think that has stood it in particularly good stead, is that we've always had a very cautious approach to acquisitions. We don't make acquisitions unless they really do make strategic sense, unless they really do offer us exciting earnings enhancement opportunities. Something like Eurolux certainly does that. We are currently trading under cautionary, so I've got to be cautious of what I say, but we are looking at opportunities. We see opportunities all the time. And every now and again, when we find one that really fits our criteria and our vetting process, then we look to...
So with that being the case, then what all shareholders are interested in is that dividend policy and how much they're possibly going to be getting back. I mean, you've gotten pretty aggressive in that dividend policy over the last couple of years. Are we looking forward to that getting more aggressive as we move forward?
Certainly that's something that I can't comment on. That's something that the board engages. Every year, our current dividend policy is to pay 40% out as an annual dividend each year. And every year when we sit down with our annual results as a board, we engage on what is the cash flow position of the company, what are the growth prospects, what are the acquisition pipeline look like, and ultimately how does that impact on the extent of free cash that we've got and how much needs to be returned to shareholders. We certainly don't anticipate any tightening in the dividend policy. Whether it will get more aggressive or not really is a function of what the growth prospects look like when we sit again in August.